welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, earlier this month, two leading fund houses delayed payment to investors in their FMPs, the fixed maturity plans, with one MF actually rolling over the scheme by 380 days. What was the reason? The Essel group to which they had lent was unable to honour its repayment obligations. With fund houses having an exposure of almost 8,000 crores to the Essel group alone and more defaults including possibly IL&FS, what does this mean for the future of mutual funds and more importantly for the investors in these funds? In hindsight, has the mutual fund industry bitten off more than it could chew with its mutual fund sahi campaign? Is a very rapid growth to date going to prove its very undoing? To discuss that and a host of other related issues, I have with me a panel of experts. A. Balasubramanian, former chairman AMFI, Association of Mutual Funds of India, and presently Chief Executive, Aditya Birla Sun Life Mutual Fund, Anant Narayan, Professor, SBJ Institute of Management and Research, and Mr. J.N. Gupta, former Executive Director, SEBI. Welcome to the show, Bala, Anant and Mr. Gupta. First it was longer-term debt mutual funds and now it is FMPs, fixed maturity plans and liquid funds that are facing the heat. Is this part of the normal maturing of the market where the initial enthusiasm gets tempered with realism, or will it be a case of once bitten twice shy for retail investors? Many of you had switched over from bank fixed deposits to FMPs attracted by the higher returns and oblivious, it would seem, of the higher risks. Let me start with you, Bala.
Yeah, I think you have to look at from this angle that the Indian debt markets got evolved over many number of years, and increasingly the mutual fund role in development of the bond markets has been increasing. And the bond market, as you know, is it's a mix of high quality government bonds and then high quality AAA bonds, and then go down the credit curve. Which goes down to as low as about BBB kind of bonds, and different kind of lending mechanism that works while of course dealing with the corporate bonds. And the mutual fund industry players having started especially in offering fixed income product as way back in 1994, have gone through these cycles of ups and downs, especially the financial market have gone through multiple round of ups and downs, and fixed income especially have gone through some ups and downs during this period, and it got evolved and matured over a period of time. I think the point that you are mentioning is, I think the one fundamental principles on which the fixed income market functions, which is purely the mix of investment that we make, AAA and below AAA and other credit that we take, and obviously some of the credit risks that we take would go through some ups and downs as we normally see in any other market, and therefore keeping that in mind, this kind of accidents when it comes to the financial market, naturally even fixed income schemes also go through some kind of pain. And having said that, one should also remember the mutual fund fixed income product, given the fact that it has got a high component of the NAV movement coming from the accrual of interest and the rest coming from the price fluctuations. Therefore, one has to look at 3 to 5 year kind of time period while investing in fixed income schemes, while comparing that with fixed deposit. One should also keep in mind the tax adjusted return that you get over a period of time.
Sure. Would you agree with that, Anand, or is the mutual fund industry guilty of presenting an excessively rosy picture? Because if you listen to the mutual fund sahi campaign, there is this disclaimer, mutual funds are subject to market risk. But the way it is said in such a haste, it's very difficult for ordinary investors to even understand what they're saying. Yes, in a market economy, it is caveat emptor, buyer beware. But must we have a different yardstick for financial products, especially in a country where literacy, let alone financial literacy levels, are so dismal? Anand?
Well, Mythili, I agree with your broad proposition. I think mutual funds have done a good job over the years. The increase that we are seeing in AUM and therefore the depth in capital markets is to be welcomed. And I think it's part of a teething process where as you grow, you suddenly realize there are shortcomings which need to be addressed. I just hope the mutual fund industry understands that these shortcomings are real and they need to be addressed post haste, and they have to proactively address these issues rather than waiting for others to solve it for them, because they are the experts. And to me, the current issues which remain, first, the size of the secondary market is abysmally low compared to the AUMs of the mutual funds. Mutual funds have 13 lakh odd crores of debt instruments with them. Most of it is in corporate bonds and in non-government paper. The actual volumes in the secondary market, real secondary market corporate bond volumes, is less than 1 lakh crores in a month. So clearly the NAVs that we get, the valuations that we get for mutual fund paper, even if they are good paper, is really not to be, we don't know how much we can trust them. Second, the whole point about how these mutual funds are sold to investors using, over 100,000 actual salespeople on the ground who are registered by AMFI. There are questions about suitability appropriateness, about disclosures, about making sure the investors understand the risk. Particularly as small investors come into the fray, I think the industry has to do a lot more in ensuring that customers are adequately appraised of the risks, the actual charges that they're paying, and so on and so forth. Lots to be done out there in terms of disclosure and suitability appropriateness. Third, we have to understand, especially when it comes to debt mutual funds, the government has a big role to play. It's actually giving tax incentives. I would rather invest through a mutual fund than invest directly in bonds, simply because tax adjusted returns are far better in a fund. Now, is that something really that we want to happen? Plus, there are lots of other issues which need to be sorted out.
Okay, Mr. Gupta, Anand pointed to a number of areas where the mutual fund industry needs to do more. So my question is that in our anxiety to move away from a bank-dominated financial system, have we papered over the risks, especially in the context of the debt markets? Unlike in the case of equity mutual funds, where retail investors now seem to have understood that these are risky investment. Is this learning yet to happen with debt mutual funds? And is there also a danger that when we have large inflows into these funds by way of SIPs, that could in a way aggravate the risks because we might have too much money chasing too few good quality assets? Mr. Gupta?
See, I would start by saying that as you rightly pointed out and Bala has pointed out, the mutual fund industry has grown by leaps and bounds in last couple of years. Now, when the growth like this happens, some accidents bound to happen. Now, this we should say that this is one of the accidents that some two mutual funds could not redeem their FMPs in time in full. Now, we got to question first whether this accident was because of high risk taking by the mutual funds or because of some infrastructure issue, because accidents do happen because of the mistake of the driver or because of some infrastructure issue. Now, here it is both partly. The first is infrastructural issue is this, that this probably the default would not have happened had the liquidity in the secondary market was there. Now, we all know that SEBI has been trying for ages, RBI has been trying for ages to improve the liquidity in secondary market. The second thing is this, that did they take risk or something like this? The fact is that when you grow, your opportunity are limited to invest, and that is in that process the risk was taken. The issue was that whether this was disclosed or not, and probably every disclosure was not made, but again you have to say that when you make a regulation, when you make disclosure, you cannot envisage all future problems. So, this is the lesson number one from here, that mutual fund need to increase their disclosure.
That is true, very true. We do need greater transparency. But Bala, mutual funds are essentially pass-through vehicles. But is the mutual fund industry guilty of giving a rather one-sided picture, the promise of higher returns without spelling out in sufficient detail that if banks give you a lower return, it's because they're subject to much higher degree of regulation, SLR, CRR, income recognition, provisioning norms, but the mutual fund industry are relatively less regulated and hence riskier. Because as Andy Mukherjee said in a recent column, relationship lending is to be expected in a state-dominated banking system. But relationship-based fund management, that is something that is unheard of, Bala.
Yeah, I think of course there is element, some bit of untruth in what you are saying, that what Andy also mentioned about. I think as I mentioned earlier, industry has been primarily responsible for offering a product coming from fixed income, which is completely underowned in the entire financial system as of today. And second is when you compare though the 13 lakh crore size that you are talking about fixed income, if you look at the number of investors who are in the fixed income schemes across the mutual industries, will not be more than about 20-25 lakh investors from retail, or it can go up to about 30-35 lakh investors, as against almost about 2.5 crores unique investors that we talk about in equity schemes. Therefore, it still remain underpenetrated when it comes to the question of taking the fixed income market to the retail level. Therefore, the assumption that people are making, a lot of money got shifted from fixed deposit actually into the mutual fund schemes, that is yet to happen big time. I think we still have a long way to go, and this is one of our aspirations actually to grow the size as an alternate product to the fixed deposit over a period of time. Having said that, I think one, mutual fund is a pass-through vehicle, clearly I think is understood. when you make big money, assuming a scenario, you take a good call on credit, take a good call on rates, and as a result of that, if you make return in excess of what normally would have got it, the entire return belongs to the investors. I mean, given the fact that expenses are capped and you cannot charge more than certain expenses, that's why the regulatory environment has been fixed. Therefore, when there is huge benefit comes that accrues to the investors, at the same time when there is element of loss that happens, that also accrues to investors. Having said that, we all as money managers have to of course behave responsibly, as Anand mentioned, and industry of course do that, and at the same time, if you look at the industry through the AMFI as a body, work closely with Security Exchange Board of India in framing various regulations after every accident that happened in the last 25 years. I think one has talked about valuations. Is something that got evolved over a period of times. There is absolutely no doubt secondary market liquidity in India is bad. At the same time, the entire market today, we can take pride. The yield curve is reasonably, we can draw it because of the larger participation that come from the mutual fund industry players. But you must note one point, on a 13 lakh crore, what is the amount that we are discussing about is at stake? It actually is about less than 0.2, 0.3% of the overall assets under management. As again the banking system, what you are talking about, where the NPAs are running in huge number, whereas the mutual fund, the accident that has caused to some kind of unpleasant feeling. But what is the amount involved in that? It's, I think, total industry size, the amount involved is together is not more than 7,000-8,000 crores.
Sure, but Anand, I'm not quite sure I agree entirely with Bala, because retail investors, they are far safer with bank deposits to the extent that no bank is going to turn them away when they come asking for the money. In fact, received wisdom is that it is only banks that are systemically important. But what we're increasingly realizing is that the financial sector players don't function in silos. If one entity, say it's a mutual fund, is forced to sell some of its bond holdings, it can set off a panic in the rest of the market and impact not just other mutual funds but the larger ecosystem itself. So how can we guard against this? Can we ring fence risks from mutual funds so they don't endanger the rest of the financial system? That really is my worry, and as we've seen, that has not happened in the past. There have been tremors felt throughout the financial system. Anand?
A great question, Mythili. So look, first off, personally, I don't have a single bank fixed deposit. I don't own bonds other than tax-free bonds. I only invest through debt investments in mutual funds. Simple reason, on a tax adjusted basis, there is no other investment which makes sense. And we have to understand there is, while Bala is right that the number of penetration of retail is not as much as in equity, clearly it's a growing class purely chasing the fact that tax arbitrage exists. To your larger point, absolutely, the moment you have 12-13 lakh crores of instruments in debt mutual funds and the secondary market liquidity is a fraction of that, you are running into a situation, and we nearly saw that in September last year when IL&FS happened, where mutual funds had to run to SEBI and to RBI, ask for some kind of backstop facility since there's no lender of last resort for corporate bonds. Thankfully, that lender of last resort was not required. But the moment you have a situation of such a lopsided holding as opposed to the actual secondary market volumes, you will open yourself to this vulnerability. I agree with Bala that the amount of bad or questionable credit paper is quite small, but even with good paper, if there is no secondary market liquidity, who's to determine what the right price is? And you're absolutely right, there can be a spill-off effect into the entire ecosystem, not just mutual funds and the 35 odd lakh retail investors. It goes beyond that. To the larger point on disclosures, here's my reading, Mythili. Look, I'm friendly with a lot of fund managers and they're good friends, and they keep fighting with me for all that I say on mutual funds. But I know they're good people. They're people who actually have the interests of the ecosystem at heart. Where I think they face pressures is that this chase for AUM and the fact that you have one fund offering a certain high return, and unless they offer a matched return or better return, they won't get that flow coming in from the sales side, from the clients. And therefore, they have to go down the credit curve. Therefore, they have to go into loans against shares and other structures they would otherwise not do. Therefore, they have to rely on credit rating agencies so that they can offer a better return to their individual clients. I think this is where we need a little bit more of introspection. You have to understand that you are in charge of the ecosystem. If the secondary market volumes are not enough, you cannot grow beyond a certain size. If you're endangering the credit by actually going down the credit curve to offer better returns, you have to make sure the investors are fully aware of that, not just through a small byline of a disclaimer. And the disclosures when it comes to NAVs. When you had this accident on Z paper, the broad NAV on that paper did not change. The valuation of the paper did not broadly change. It's still maintained at A or whatever on the rating scale. So today you are holding NAV you're showing NAV at a much higher level. Redemption is at a much lower level. So what is the whole meaning of NAV if you're not providing that today in today's value?
Yes, a lot more really needs to be done, and we'll turn to what the regulator has been doing, but after a short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three experts on what is really happening in the FMP space and what can be done to prevent such recurrences. Mr. Gupta, you were an ED with SEBI earlier, so perhaps you're best placed to answer my next question. And this relates to concentration risks. Sure, SEBI has specified exposure limits. Increasingly, what we're seeing, however, is that many funds have exposures much in excess of the prescribed limits. So what is the use of a regulator issuing some diktats when it's unable to follow through to see that they're carried out? In the case of, some mutual funds, we're seeing the DFHL funds, etc., with very high exposure to group companies. At the very least, SEBI should ensure that fresh subscription is not allowed into these funds. Would you agree, Mr. Gupta, that SEBI has also been found wanting?
See, it is a very big question, important question, and a very difficult question to answer. The reason is that it has both sides. One is, say for example, there is a mutual fund which is promoted by a big conglomerate and it is a very successful. I will take an example, say for example, HDFC. Now, if we have seen HDFC is a successful mutual fund and it has a very successful bank, it has a very successful housing company. Now, if I as an investor in HDFC mutual fund come to know tomorrow that HDFC mutual fund will not be able to invest in HDFC bank and HDFC limited, then probably I feel that I am being denied the share of two prominent companies into the index where my gains could have been right. So, right from beginning the success of HDFC mutual fund would be in doubt. Therefore, it will be unfair to the investors of HDFC mutual fund to do this. The other side is that yes, it carries a risk, because what happens, you may be an insider, secondly you may be supporting because of the, although the management is separate, but there is some commonality there, so you may be supporting the thing. So, I think the solution does not lie in stopping that, solution lies in putting a limit as well as a exposure, and probably a special exposure which is not in the very fine print, but in a very bold print, that out of X amount of corpus, this much portion has been invested. And secondly, a disclosure should be made what has been the highest and what has been the lowest exposure during the year, and what type of trading that has happened in that stock. That is one. The second is, as you say, that the concentration risk is bound to happen sooner or later, in the sense, if you grow in the size from X amount to 10x in last 5 years, then probably somewhere or other you will fall short of good investment opportunities. Now, if you are short of good investment opportunities, then you feel that either you stop growing, or if you grow, then you have to increase concentration. A solution has to be found by regulator by having a stages of exposure, that if you have breached that much exposure, then trustees of the mutual fund house should take a very clear cut call that why they are wanting to increase exposure in that particular group or particular company, and what type of risk assessment they have made.
Absolutely. In fact, Bala, can I toss the same question to you and ask you also very quickly that this entire thing of ring fencing, segregating all the poorer quality assets, is that merely optics? How fair is it fair to the investors? So, two questions and two quick answers from you, Bala.
I think clearly, I don't know how many of you would have noticed, post the categorization of mutual fund schemes within the fixed income space, we had a lot of debate at the industry level as well as at the SEBI level. We did, of course, I must also admit that we did lobby for not changing the name of Credit Opportunities Fund to Credit Risk Fund. And we had multiple round of discussion. We said that credit opportunities, there is a market exists in order to generate 2 or 3% extra return over the normal schemes which invest only in AAA and highly safe asset class. And while the opportunity still remains, there is absolutely no denial on that. At the same time, finally the regulator felt that while the opportunity exists, I am not saying no, but at the same time the risk is also equally high. Therefore, all of you have to call the fund that invest in less than AA plus and go down to the as low as about BBB kind of bonds, investment grade bonds. The name of the scheme has to be called as credit risk fund. And if you look at today, I think first time in India has happened, and all such funds which invest in less than above BBB and less than AA are called as credit risk fund. The scheme itself credit risk fund. When you go and offer the product to a customer, or the distributor goes and offers this product to the customers, clearly if he says I am investing in a credit risk fund, then investor can ask an obvious question, what do you mean by the risk? So there are two levels in which we are addressing that. One at the scheme level, name itself is addressing it, and second thing is below that there is a tagline that I will give which clearly mentioned that how the investments are going to be made, which also now made it mandatory for disclosure, and then on top of it the disclaimer that we are putting in the bottom. Maybe one of the additions that can be made actually is to make investors understand the credit risk fund can go through this kind of volatility, and therefore they may have to go through some period of uncertainty when this kind of occasion comes. The last point I actually also just want to mention, I think you mentioned about the refunded assets. I think one of the asset classes in India has gone through a tough time, especially in the post IL&FS crisis. Some of the assets where the money managers have made an investment, purely on the assumption that you are discounting the annuity receivables from the government or NHI toll collection and so on and so forth, have actually come under the question mark post the NCLTA admission of IL&FS and NCLTA, and clearly is something which is unexpected. And when such thing happens, these are incidents which doesn't happen so frequently, but when such thing happens, of course we as money managers definitely will become a little bit risk averse. At the same time we will start questioning ourselves, have we made the right investment? But having made the right investment, having made the right analysis, when we go through these kind of things, definitely of course the best that we can do is to actually be in the forefront and make the investors understand the credit risk, and also look at inwardly that what are the kind of exposure that one can take as the percentage of the total exposure of the overall portfolio. These are some of the risk management practices that can adopt when we manage the portfolio.
Sure. Anand, Bala is entirely right that investors need to ask more questions, but in the recent examples that we've quoted, mutual funds also seem to have got carried away by the fact that they held the collateral of shares of these very same companies that had been pledged to them, seemingly oblivious of the fact that the share price of a company cannot be divorced from what is happening to its debt. At the core, both debt mutual funds and banks do much the same thing. They lend to corporates. But while banks have little or no flexibility to go in for standstill agreements with their borrowers, particularly post IBC, mutual funds seem to have got away by coming to a cozy understanding with their borrowers that they will not encash the shares held as collateral with them. Is that desirable or even fair?
Mythili, I don't want to get into specifics. I broadly agree with what Mr. Gupta said, that I think trustees would act in the best interest of the investors, and I tend to trust that. I think the system will work in that direction. But some few broad large points. One, as Bala says, of course mistakes will happen. I've been a bond trader, I've made wrong investments, I've made wrong calls, and I know that this is inevitable. You will in a course of 20 years make wrong calls. The question is, in making those calls where you being adequately careful, were you relying on your own judgment, or were you relying on the judgment of a third-party credit rating agency? Were you aware of what the liquidity or illiquidity of the paper is in making those investments? These are hard questions which have to be asked. Second, Bala rightly said there is enough caveat emptors which are given on paper to investors. When you're sold a mutual fund, Mythili, I'm sure you sign off on a lot of papers which hold a lot of caveats, and you agree to all those caveats. But the reality is different. On the ground, when you have 1 lakh people selling on the ground, you don't know how the sales are happening. And I can tell you there are reports which are credible reports of mis-selling on the ground. When accidents happen, you have to be honest. You cannot rely on NAVs and mark-to-markets and valuations, which you know is not right. If that Z paper has failed, its valuation is not par. You cannot hold it at par when it comes to maturity date. These are simple, egregious issues which have to be kept in mind. You cannot have dishonest or things which are bordering on dishonesty in terms of disclosure. So as long as you're careful in your investments, as long as your investors know exactly what you're running, and as long as you're completely honest about the mistakes you make, I have no problem with mistakes. Unfortunately, I think the industry has a long way before it can claim to have achieved all three.
Very true, very true. But I'm afraid we're running out of time very rapidly. So I'll give Mr. Gupta the last word, and I'll ask you just this one question, Mr. Gupta. Mutual funds have taken shelter behind the rating agencies. But the fact is that we've seen with rating agencies, you really cannot depend on them. So is it not time the mutual fund industry also developed its own credit appraisal skills, Mr. Gupta?
See, I would say that if you look at many failures, credit rating agency comes out to be the biggest villain. 2008 crisis, everything was credit rating agency. Now, the issue is the inherent conflict that is there in credit rating agency. It is the person who is being rated is the paying person. So, that as long as that conflict remains, probably credit rating agency will not, or credit rating will not be a tool which can be blindly accepted. I would agree, and I had said earlier that mutual funds will have to, because if they are lending money, then they have to develop skills as are available to the bankers for lending, and then they will have to secure it properly. And I would not agree that whenever they are lending against shares, they will have a covenant that they will not liquidate the shares or no. That I don't think should be the approach. If there is a share, underlying share, they should have a right to liquidate the share. But I would say at the end, there is nothing in this world which is worth having which does not have a risk. So, if you are invested in mutual fund, you are bound to have a risk. You got to evaluate what is your capacity to take risk and what is the type risk. The problem happens when I am told the risk is small, whereas risk is actually big, and that is where the disclosure issue is there.
Sure, there really is no answer to financial literacy. So much needs to be done by the retail investors, by the industry, the regulator, as a whole host of other people as well. Thank you so much, Anand, Mr. Bala, as well as Mr. Gupta, for joining me in the discussion. Thank you also for listening. Remember, we'll be back next week with yet another edition of Macros with Mythili. In the meantime, I hope all retail investors and the industry thinks very carefully about the issues we've raised and does something to improve the situation. Thank you so much.